Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area A1, and this is an application topic, and actually, this is the same topic from the previous video. Apply the conceptual framework for independence included in the AICPA Code of Professional Conduct to situations that could present threats to compliance with the rules included in the code. So again, this is independence part 2 because there's a lot of little rules and situations that are applied to independence, so that's why we're doing another video on independence. And again, we're going to be doing it the SuperfastCPA way, which is diving straight into the questions. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. Again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam so that you don't waste months or even years of your time struggling with these exams. And after you've watched that webinar, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member, because SuperfastCPA Pro members not only get access to the Pro course, but they also get access to the full 10-question versions of these 5-question YouTube videos. So again, these YouTube videos are typically 5 questions, but I also usually record a 10-question version of the videos where I do another 5 questions to help Pro members learn the material a little bit more. So if you like this and you like our other material, make sure you check out the webinar and make sure you check out becoming a Pro member, because those will be great resources for you to try to pass the CPA exam. Now, with all that said, let's dive straight into the questions for independence part 2. All right, here we are at question 1, and something I always like to point out, and again, it's not useful in every single situation. In this situation, it might not be that helpful, but you always want to read the last part of the question first to understand the context of what you're dealing with in that question. This question is a pretty small one, so you might not have to do it in this case if it's only like 1 or 2 sentences long, but this is a really good habit to be in no matter what, because when you see bigger questions that have a paragraph or multiple paragraphs of information, reading the last part of the question first helps you to know what is going on in the question and what you're actually looking for. It gives you that context so that you can read through the whole paragraph of the question and know what you're looking for, instead of starting at the beginning of the paragraph, reading the whole thing, and then only at the very end knowing what you were supposed to be looking for, and then you kind of have to reread the whole paragraph again. Again, read the last part of the question first. It will give you context. So let's do that with this one, even though it's not totally necessary. Which of the following activities would impair the auditor's independence? An auditor is engaged to audit the financial statements of a company. So again, which of the following activities would impair the auditor's independence? So A, preparing journal entries based on information provided by management. B, reviewing the company's internal controls to identify potential weaknesses. C, authorizing transactions on behalf of the company. Or D, providing guidance on the proper presentation of financial statement disclosures. So out of all those things, which one of these is going to impair the auditor's independence? Again, if you haven't watched the previous video, Independence Part 1, then you should probably go watch that before you watch this. If you have watched it though, I would bet that you have a basic understanding of what independence is, and you could probably pick out what the thing is here that will impair the independence. But if you haven't watched the previous video, or if you don't know the answer, that's okay. We're going to dive straight into the answer for this one to start learning from these questions. All right, here we are. The answer is C. Authorizing transactions on behalf of the company is something that would impair independence. So let's walk through this explanation. Independence is required for an auditor to maintain objectivity and credibility. Auditors must not perform management functions or make decisions for the company they audit. Activities that impair independence include authorizing transactions, acting as management, or signing checks. While preparing journal entries or providing guidance on financial statements is permissible if management assumes responsibility for them, authorizing transactions crosses the line into prohibited territory. Reviewing internal controls is also permissible as it does not involve assuming management responsibilities. So basically, the gist here is if you are an auditor, but you are starting to do things for the company, like you are managing its employees, or you're signing checks for them, or basically kind of starting to help them run the company rather than just being an advisor or just being an auditor, that's when you have impaired your independence at that point. So again, you can't be doing management responsibilities or authorizing transactions on behalf of the company or anything similar to that. So that's another rule about independence. Now let's go to the next question. All right, here we are at question 2. Which of the following best describes the impact of this arrangement on the auditor's independence? Okay, let's go up to the top. An auditor is engaged to audit the financial statements of Green Valley Farms, a privately held company. During the engagement, the company's CEO proposes an alternative fee arrangement. The CEO suggests that the auditor receive payment only if Green Valley Farms successfully secures a loan from its bank, which will be based on the audited financial statements. So again, based off that, which of the following best describes the impact of this arrangement on the auditor's independence? So out of these different options, and I want you to read through them, maybe pause the video if you need to, what do you think is the response to this? Is this something that is going to impact the independence of the auditor? Again, based off the first video, if you've watched that, and even just based off the first question, independence is not a super difficult topic to understand as long as you understand the idea behind independence. So if you have an idea, pause the video and think about the answer. If you still don't know, that's okay. Again, we are learning from these questions and using them to understand what we're supposed to be doing. So pause the video if you want to. If not, let's go ahead and look at the answer together. All right, here we are. The answer is B. The auditor's independence is impaired because contingent fees are prohibited for audit engagements. So this was a contingent fee, and let's walk through this. It'll make sense as we dive into the explanation. Contingent fees are strictly prohibited for audit and other attestation engagements as they compromise an auditor's independence. A contingent fee creates a direct financial interest in the outcome of the audit, which undermines the auditor's objectivity and professional skepticism. In this scenario, tying the auditor's fee to the company's ability to secure a loan creates a conflict of interest and violates independence requirements. Disclosing or obtaining approval for the fee arrangement does not resolve the impairment. Only fixed or standard fees are permissible for audit engagements. So essentially, a contingent fee is saying, hey, we'll only pay you if this specific thing happens, which a lot of times that specific thing is something that the auditor would have to kind of change things or maybe overlook things or basically try to get a positive outcome when maybe there shouldn't have been a positive outcome. Again, this creates an impairment on independence, obviously, because they're saying you're only going to get paid if this certain thing happens, and so the auditor is going to do whatever it takes to make that certain thing happen. Well, that is not allowed. Contingent fees are not something that is allowed for audit engagements. So that's another rule for independence. Contingent fees are a no-go. Let's go to the next question. All right, here we are at question 3. Which of the following attributes is most critical for the auditor to maintain independence and perform the audit effectively? Let's go to the top. An auditor is engaged to perform an independent audit of Blue Horizon Co.'s financial statements. So again, which of the following attributes is most critical for the auditor to maintain independence and perform the audit effectively? So let's read through these. A thorough understanding of the client's internal policies and procedures. B, sufficient training and technical proficiency to conduct an audit. C, a strong relationship with the client's management to facilitate open communication. Or D, detailed knowledge of the industry's history and trends over the last decade. So with all that information, again, which one of these is most critical? Maybe there are one or two of them that could be useful for independence, but again, which one of them is most critical for independence and performing the audit effectively? Maybe pause the video, think through these different options, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is B, sufficient training and technical proficiency to conduct an audit. So that's the most critical out of these different options for maintaining independence and performing the audit effectively. So let's walk through this and it'll make a little bit more sense. An independent auditor must possess adequate training and technical proficiency to plan, perform, and evaluate an audit effectively. Independence also requires the exercise of professional skepticism, ensuring the auditor remains objective and does not rely solely on information provided by management. While understanding the client's internal policies and industry trends is beneficial, these are secondary to the auditor's technical competence and independence. Maintaining a strong relationship with management is not required and, if taken too far, could compromise independence. So basically, again, out of these, this was the most important because an auditor has to be competent. They have to be able to do their job to be able to maintain independence, because if they can't do their job, then they won't notice the things that are causing impairment of independence, and they'll do things they're not supposed to. Of course, understanding internal policies and industry trends is important, but again, those need to come after the auditor is sufficiently trained, they're sufficiently competent to be able to even perform an audit and know when they should or shouldn't do certain things. So again, the most important part in this question is they need to have sufficient training and have professional skepticism to be able to maintain their independence. With that, let's go to the next question. All right, here we are at question 4. How does performing this service impact the auditor's independence? Let's go up to the top. An auditor is engaged to audit the financial statements of Sunrise Realty Group. During the engagement, Sunrise's management requests that the auditor perform an appraisal of the company's commercial property portfolio to determine its fair value for inclusion in the financial statements. The property portfolio represents a significant portion of the company's total assets. So how does doing an appraisal for their property, which is a big part of their financial statements, affect the independence of the auditor? I think that based off what we've talked about in this video, and if you've seen the previous video, you can probably have a good guess at this. So pause the video, think about the answer yourself, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is B. Independence is impaired because providing valuation services for material items creates a self-review threat. So let's go to the explanation. Auditors are prohibited from providing valuation or appraisal services for audit clients if the valuation is material to the financial statements. So if it's a big part of their financial statements, it's a big deal, then this would create an impairment on independence. Performing such services creates a self-review threat where the auditor may be in a position of auditing their own work. This compromises the objectivity and independence necessary for an effective audit. Disclosure or third-party approval does not mitigate this impairment. Auditors must avoid services that involve making management decisions, we talked about that in question 1, or significantly influencing financial statement amounts. So again, an auditor should not be making decisions for a company. They should not be evaluating the company's own assets, because then again, if the auditor has to then review that evaluation, they're going to not be independent. They're not going to be objective because they're the one who created that evaluation of the asset. So things like that you cannot do and still maintain independence because you're creating self-review threats. Okay, so that was another rule. Now let's go to the next question. All right, here we are at question 5. How does this business relationship affect the auditor's independence? Let's go up to the top. An auditor is engaged to perform an audit for Maple Leaf Co. During the engagement, the auditor invests in a partnership with Maple Leaf's CFO to co-develop a commercial property. The partnership agreement includes joint decision-making on property management and profit sharing. So again, how does this business relationship affect the auditor's independence? We're 5 questions in. We've learned a lot in the first 4 questions, and again, if you've watched the previous video, the other 5 questions, I think you have a decent understanding of independence at this point, so I'm going to have you pause the video, think about this, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is A. Independence is impaired because the auditor has a direct business relationship with a key member of the client's management. Okay, that makes sense. This would impair independence, so let's walk through this. Auditors are prohibited from having direct or material indirect business relationships with the client or its management. Engaging in a partnership with the CFO creates a conflict of interest and impairs independence as it compromises the auditor's ability to remain objective and impartial. Disclosing the relationship or limiting its scope to activities unrelated to the audit does not resolve the impairment. Independence is essential to ensure the credibility of the audit, and any direct financial involvement with the client's management violates professional standards. So even though they are developing a separate partnership, again, because they are dealing with the CFO and they're starting to have this relationship with them where they are probably trusting them, that's going to create an impairment on independence, because then when the auditor is auditing the financial statements of Maple Leaf Co., they're going to trust the CFO more than they should, because again, they kind of have a financial interest with that CFO, and they don't want to see that CFO go down or have any issues because, again, they are a partner with the CFO in a different property. So again, that was another situation that's going to create an impairment on independence, and we've learned a lot in these 5 questions, and again in the 5 questions in the previous video. Before we do anything else, let's do one more part of the SuperfastCPA process again, called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen these things pop up 2, 3, or 4 times. You've seen 3 or 4 questions trying to teach you about the situations where an auditor would be considered in a management position and that would impair independence, or whatever the case may be. You see these things pop up throughout the questions, and you know that they're important based off of what you've seen in the questions, so you write them out as pillar topics in your own words, and as you do this each day, you're going to be building your own personal repository of the most important things you need to know for the CPA exam. So with that, let's go to the pillar topics for this video. Okay, here we are at the pillar topics. Let's just go ahead and read through these. Again, this is another 5 pillar topics for independence. We already had 5 pillar topics in the previous video, so again, there's a lot of things you need to know for independence. That's why it's kind of a difficult topic. Not because it's a hard concept to understand, but because there's a lot of different applications. Let's walk through this. Prohibited management functions. Auditors must not perform any management roles or assume responsibilities that belong to the client's management, such as authorizing transactions or signing checks. There's also a ban on contingent fees for audits, tying an auditor's compensation to the outcome of the audit, such as tying it to a loan approval, only if, saying we're only going to be able to get this loan approval only if you give us a favorable audit, so we're only going to pay you if you give us a favorable audit, that's going to create a contingent fee. That impairs objectivity and is not allowed for audit engagement. Let's also talk about requiring training and professional skepticism. Auditors must have sufficient education, technical skills, and the capacity to remain impartial and question information critically. And again, that comes from correct training, and it's important for maintaining independence and, of course, important for a lot of other things in auditing as well. Self-review threats from valuation and appraisal services. Providing valuation or appraisal services for significant items in the client's financial statements impairs independence, as the auditor would be auditing their own work. So you can't be evaluating or appraising big things for the client, because again, that could make it so that you end up auditing your own valuation, your own appraisal services. And then finally, business relationships with the client. Engaging in direct or material joint ventures or partnerships with client management creates conflicts of interest and impairs the auditor's independence. So again, those were another 5 pillar topics about independence, and that is the end of independence part 2. We've gone over a lot in the past 2 videos, and I hope this was helpful. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com if you haven't already done that. Again, it's only 1 hour. It is free, and we will teach you the key ingredients to passing the CPA exam. And after you watch that webinar, the next thing that you need to do is go check out becoming a SuperFast CPA Pro member. SuperFast CPA Pro members get access to the Pro course, where Nate explains exactly what you're supposed to be doing in detail every single day, but also Pro members get access to the full 10-question versions of these 5-question YouTube videos. So if you like this and you like our other videos, remember you can get the access to the full 10-question versions of the videos if you become a SuperFast CPA Pro member. So with all that said, again, I hope this was helpful. If you liked the video, make sure to like it and leave a comment, and I will see you in the next video.